Would you rather own a company that pays you regular income or one that reinvests every dollar to grow even faster? That's one of the biggest decisions investors make. In just 5 minutes, I'll explain what dividend stocks are, how they work, and some important advantages and disadvantages you should understand before investing. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. A dividend is a payment that a company makes to its shareholders. When a company earns a profit, it has several choices. It can reinvest the money back into the business, reduce debt, buy back its own shares, keep cash for future opportunities, or return part of those profits to shareholders as dividends. If you own the shares when a dividend is paid, you'll receive your share of that payment. A dividend stock is simply a company that regularly pays dividends to its shareholders. These are often established businesses with consistent earnings. Many banks, utilities, and consumer goods companies have paid dividends for decades. It's important to understand that dividends aren't free money. Every dollar a company pays to shareholders is a dollar it can't reinvest in growing the business. Some companies prefer paying dividends. Others reinvest almost everything they earn because they believe it will increase the company's value over time. Neither approach is automatically better. They're simply different ways of rewarding shareholders. Let's look at a simple example. Imagine you own 100 shares in a company. Each share is worth $5. Your investment is therefore worth $500. The company announces a dividend of 50 cents per share. Because you own 100 shares, you'll receive $50 before any applicable taxes. If you decide to reinvest that $50 while the share price remains at $5, you can buy another 10 shares. You now own 110 shares. Next time the company pays a dividend, you'll receive income on all 110 shares. Over time, this is one of the ways investors can grow their investments through compounding. For simplicity, this example ignores taxes, brokerage fees, and changes in the share price. Many investors like dividend stocks because they can provide regular income. Some use that income to help pay everyday expenses. Others reinvest every dividend to build wealth over many years. Dividend-paying companies are also often mature businesses with established earnings, although this isn't always the case. A higher dividend isn't always a better investment. Sometimes a company offers a high dividend because it's performing well, but sometimes the dividend yield looks high simply because the share price has fallen sharply. That can be a warning sign. If profits continue to decline, the company may reduce or even stop paying its dividend. Remember, higher potential returns often come with higher risks. It's also important to remember that dividends may be taxable. The rules vary depending on where you live and the type of investment account you use. Even if you reinvest your dividends, tax may still apply. Before investing, it's worth understanding the tax rules in your own country. Dividend stocks can be an excellent way to generate income and build long-term wealth. Some companies choose to pay dividends, others choose to reinvest their profits for future growth. Neither approach is automatically better. Understanding the difference will help you build a portfolio that matches your own financial goals. If you found this video helpful, please consider subscribing. It costs you nothing, but it really helps the channel and allows us to continue creating simple investing videos like this one. Thanks for watching, and I'll see you in the next video.